Here's a thought experiment I want you to sit with for just a moment. Imagine you work 40 hours this week. You put in the time, do the job, deliver the results. And then, before your employer hands you anything, before a single dollar touches your bank account, somewhere between 20 and 37% of what you earned simply disappears. Gone. Not invested, not saved, not donated to a cause you chose. Just gone. Redirected automatically, invisibly, before you ever had the chance to call it yours. Now here's the genuinely strange part. Almost nobody finds this upsetting. In fact, most people would find it strange that you're even describing it that way. Because we don't experience it as money being taken. We experience our net pay as our pay. The rest is just taxes, a background fact of life like gravity or the weather. But what if that feeling of naturalness, that sense that of course this is how it works, this is just how the world is, what if that feeling was itself an engineered outcome? What if the psychological acceptance of automatic income taxation wasn't inevitable, wasn't instinctive, wasn't even ancient? What if it was deliberately constructed, layer by layer, over about a century by people who understood human psychology well enough to make a radical transformation feel like common sense? That's what this video is actually about. Not whether taxes are good or bad, not a political argument, something deeper and stranger than that. This is about how the human mind gets restructured around financial systems, how what feels normal gets manufactured, and what the history of income taxation reveals about the mechanisms governments and institutions use to reshape the way entire populations think about money, obligation, and ownership. Stay with me, because by the end of this, you're going to look at your pay stub very differently. There's a concept in behavioral psychology called the status quo bias. It's one of the most robust and well-documented cognitive tendencies in all of human decision-making research. The core finding is simple. People don't evaluate options neutrally. We anchor to whatever the current state of affairs happens to be, and we treat any deviation from it as a loss, even when that deviation might objectively be better for us. This is why, in experiments, people who are randomly assigned to receive a coffee mug value that mug significantly more than people who weren't assigned one, even though a moment earlier neither group had any attachment to mugs at all. The moment something becomes yours, becomes the default, becomes the baseline, your brain treats it as precious. Departing from the baseline feels like losing something. Staying feels like safety. Now, apply that insight to financial systems. The question isn't just what people accept rationally. The question is what gets established as the default. Because once something is the default, the burden of proof flips entirely. You no longer have to justify the system. Anyone who questions the system has to justify their questioning. The baseline becomes invisible, self-evident, beyond debate. This is the psychological infrastructure that makes modern income taxation not just politically stable, but psychologically invisible. And understanding how it was built, brick by brick, decade by decade, is one of the most illuminating case studies in applied behavioral economics you'll ever encounter. Let's start at the beginning, because the beginning is more recent than most people realize. For the first century plus of American history, the federal government had no mechanism to tax individual income. None. It funded itself through tariffs on imported goods, excise taxes on specific products like alcohol and tobacco, and occasional emergency measures during wartime. The logic embedded in this system was philosophically meaningful. Taxes touched transactions. When you chose to buy something from abroad, you paid a tariff. When you chose to purchase a taxed good, the excise applied. But your labor, the hours you spent at work, the wages you earned, the money you received for your skills, that was yours first and entirely before any government claim entered the picture. This wasn't accidental. The legal architects of the early American Republic were deeply suspicious of direct taxation of individual productivity. They saw it as philosophically similar to forms of compelled service that free people shouldn't be subject to. The Constitution they designed actually contained provisions making it extremely difficult to implement direct taxes on individuals without apportioning them among states according to population, a requirement that made such taxes practically unworkable. So for most of American history, a working person received their wages in full and then decided what to do with them. The relationship between a citizen and the federal government, financially speaking, was almost entirely mediated through consumption choices, not through income. That world didn't just change gradually, it changed in a single year, 1913. The 16th Amendment was ratified in February. By October, Americans were filing their first federal income tax returns. In under 12 months, a centuries-old constitutional architecture was altered, and the foundational financial relationship between individual citizens and their federal government was permanently restructured. Here's the psychological point that most historical accounts miss entirely. The initial rates were almost symbolic. The top marginal rate in 1913 was 7%, and it only applied to incomes above $500,000 in today's equivalent, an almost vanishingly small number of Americans. For the vast majority of working people, the practical effect in 1913 was zero. Nothing changed in their wallets. And that, from a behavioral science perspective, is exactly the point. You don't restructure a baseline by hitting people hard at the outset. You establish the mechanism, you make it normal, you let it sit there, benign and almost theoretical, until a generation grows up that never knew anything else, and then you adjust the rates. By 1944, the top marginal income tax rate in the United States was 94%. That's not a misprint, 94. The mechanism that had been introduced as a modest symbolic gesture had, within 30 years, expanded to consume nearly all of the income of the country's highest earners. But by that point, the idea of income taxation itself was no longer contested. The baseline had been set. The status quo bias was doing its work. People argued about rates, not about the fundamental premise.
Now here's where the story gets genuinely fascinating from a psychological standpoint. Because what happened in 1943 makes everything that came before it look almost preliminary. For the first 3 decades of American income taxation, from 1913 to 1943, people paid their taxes annually. You earned your money throughout the year, you received your full wages, you held on to that money, it sat in your account or your wallet or your mattress and felt like yours. And then once a year, you calculated what you owed and you wrote a check to the government. Now think about what that process felt like psychologically. Every year, you experienced a moment of acute awareness. You knew exactly how much you were handing over. You felt the subtraction. The money was yours, and then it wasn't, in a single concrete transaction that your brain registered as a loss. Behavioral economists have a name for this kind of phenomenon: payment salience. When a payment is visible, concrete, and happens in a moment you experience directly, it feels much larger than its objective size. This is why paying cash hurts more than swiping a credit card for the same purchase. The cash is real, present, physically leaving your hand. The card swipe is abstract, deferred, psychologically softened. Annual tax payments had extremely high salience. People knew viscerally what they were paying, and historical records suggest that this produced real political friction. People complained, they organized, they pushed back. The payment was too visible, too real, too felt. Enter withholding. The modern payroll withholding system, where taxes are automatically deducted from your paycheck before you ever receive it, was introduced in 1943. The official justification was wartime revenue needs. The government needed cash flow more quickly and reliably than annual payments could provide. Fine, that's a genuine administrative rationale. But here's what the behavioral science tells us about what else withholding accomplished. It fundamentally altered the psychological experience of taxation for every American worker permanently and by design. When taxes are withheld before you receive your paycheck, several things happen to your brain simultaneously. First, the money that disappears never enters your mental accounting as yours. Behavioral economists call this mental accounting, the psychological ledgers we maintain about money. Money that you never hold, never see deposited, never experience as available, never gets fully registered as lost. It's not subtracted from your sense of wealth because it was never added to your sense of wealth in the first place. Second, and this is subtler, withholding dramatically reduces payment salience. There's no annual moment of acute awareness. There's no check you're writing. There's no single transaction your brain registers. There's just a number on a pay stub, the gross versus the net, and your brain quickly learns to treat the net as the real number, the baseline, the thing that actually matters. Third, and perhaps most powerfully in the long run, withholding changed what felt like the normal, default, expected state. Before withholding, receiving your full wages was the baseline. Tax payment was the deviation, the moment of subtraction from that baseline. After withholding, receiving your net pay is the baseline. The gross becomes theoretical, abstract, a number that exists on paper but never feels fully real. This is a profound reorientation of the psychological default, and it happened not through persuasion, not through philosophical argument, but through the structural redesign of a payment system. Nobody asked workers whether they wanted their relationship to their own income reframed. It was simply implemented during a wartime, a period when questioning government financial measures could be framed as unpatriotic, and it stuck permanently. The people who designed the modern withholding system were not naive about these psychological effects. Treasury economists in the early 1940s were sophisticated students of human behavior. They understood, in the language available to them at the time, what we would now call behavioral economics. They knew that making a payment automatic and invisible would change how people experienced it. They designed a system that by its structure would make taxation feel less like a loss and more like background noise. That's not a conspiracy theory. That's just smart institutional design. But it's worth being clear-eyed about what was designed and why it was so effective.
Here's where the story expands into something that should make you genuinely curious, because the American experience is not unique, not even close. Great Britain introduced a formal income tax in 1799, initially as a temporary wartime measure for the Napoleonic Wars. It was abolished after the wars ended, then reintroduced in 1842 and made permanent. Germany built its income tax infrastructure in the 1870s and 1880s. France debated and implemented it in the early 20th century. Canada, Australia, New Zealand, all within a broadly similar historical window. And with the income tax came, in each case, a bureaucratic enforcement apparatus, criminal penalties for non-compliance, and the same gradual normalization process. Now, the standard explanation for this convergence is modernization. Industrialization created wage labor at scale. Wage labor created a visible, trackable, taxable income stream that simply hadn't existed when most people were subsistence farmers or craftsmen trading in kind. Governments needed revenue to fund the administrative complexity of modern states. Income taxes were an efficient mechanism. Of course they spread. That explanation is real. Industrialization genuinely did create new possibilities for income taxation that hadn't existed before. But it doesn't fully account for the remarkable similarity of the mechanisms across nations that were often geopolitical rivals. It doesn't explain why the enforcement structures followed such consistent patterns. First the mechanism, then the bureaucracy, then the criminal penalties, then the normalization. It doesn't explain why the psychological features of withholding and reduced salience were adopted across such different political and cultural contexts. From a behavioral science perspective, what's interesting isn't whether there was coordination. The historical record on that question is genuinely ambiguous. What's interesting is that the same psychological levers were pulled in the same sequence, producing the same outcomes across different societies. That's a pattern worth examining regardless of its cause.
And that pattern tells us something important about how durable financial systems actually get built. They don't get built primarily through force. Force is expensive, generates resistance, and tends to be unstable over time. Durable systems get built by restructuring what feels normal, by establishing defaults that people don't experience as impositions because they've never known anything else, by making the baseline invisible. The income tax, wherever it appeared in the industrialized world, followed the same psychological playbook. Introduce at modest rates that affect few people. Establish the mechanism and its normative legitimacy. Grow the bureaucratic infrastructure. Extend rates and reach gradually. Implement automatic collection that reduces payment salience. Criminalize non-compliance to create strong deterrence. And wait for a generation that grows up inside the system and never questions its foundational premises. This is not a process unique to taxation. It's a general pattern of how institutions extend their reach while minimizing resistance. Understanding it in the context of income taxation gives you a template for recognizing it in other domains: healthcare financing, financial regulation, data privacy. Any area where the relationship between individuals and institutions is being restructured over time.
I want to pause the historical and psychological analysis for a moment and talk about something that doesn't get discussed nearly enough. What was actually surrendered when income taxation became normal, and why it matters beyond the dollar amounts. The obvious loss is financial. The accumulated taxes paid by ordinary families across 5 generations is staggering in absolute terms. But behavioral economists and philosophers of property have identified something that's arguably more significant than the financial loss: a conceptual loss, the loss of a default assumption about the relationship between a person's labor and that person's ownership of what that labor produces. Here's the conceptual distinction. In a world without income taxation, the baseline assumption is that what you earn belongs to you, entirely and first. Any government claim on your income is a subtraction from that prior ownership, a claim that requires justification, that has to be argued for, that you experience as a transfer from your account to someone else's. In a world with withholding income taxation, the effective default assumption is that a portion of what you earn belongs first to the tax system, and you receive the remainder. The government's claim isn't experienced as a subtraction from your prior ownership. It's experienced as the structure of income itself. Your net pay is your pay. The gross is just a number. This is not merely a semantic difference. It has real consequences for how people reason about economic policy, about government spending, about their relationship to political institutions. When income taxation is the default psychological normal state, the burden of proof in political arguments shifts. Arguments for tax increases are arguments for adjusting a parameter within the accepted system. Arguments for tax reduction carry the psychological weight of challenging the baseline, of asking for something, of demanding a deviation from what feels natural. Status quo bias, again, doing its work at the level of political cognition. There's a useful thought experiment here. Imagine that instead of withholding, every worker received their full gross pay each month and then received a bill from the government for their taxes due 30 days later. Same rates, same obligations, just a different structural presentation of the same financial reality. The behavioral research is very clear about what would happen. Tax payment salience would skyrocket. The psychological experience of paying taxes would be acute, concrete, and regularly felt. Political preferences around tax rates would almost certainly shift, not because the underlying economic situation had changed, but because the psychological experience of it had changed. The default, the baseline, the thing that feels like loss versus the thing that feels like normalcy, all of that would be restructured by the design of payment systems and the passage of time. This is the power of defaults. This is why the choice architecture around a financial system isn't just an administrative detail. It's the primary mechanism through which people's relationship to that system gets constructed. The pre-income tax world wasn't a paradise. It had slavery. It had extreme inequality. It had crushing poverty for millions of people. Romanticizing it wholesale would be historically dishonest and intellectually lazy.
But it did contain, embedded in its legal and financial structure, a different default assumption about the relationship between a person and the product of their labor. That assumption is now gone, not destroyed by argument, not overturned by philosophical debate, but quietly restructured by the design of payment systems and the passage of time. Let me bring this all together into what I think is the most important takeaway from everything we've covered. When people talk about political power, they usually talk about force. Laws, enforcement, police, courts, the machinery of compulsion. And that machinery is real. Income taxation does have criminal penalties, and those penalties are enforced. But force alone is an expensive, unstable way to run a system. The truly durable form of social power isn't compulsion, it's normalization. It's making the system feel so natural, so inevitable, so simply the way things are, that the question of whether it should be this way never seriously arises. The history of income taxation is one of the clearest illustrations of normalization at scale that you'll ever find. A radical restructuring of the relationship between citizens and the state, a transformation that would have seemed genuinely alarming to most Americans in 1910, was accomplished not through revolution, not through conquest, but through a patient, multi-generational process of establishing defaults, reducing payment salience, institutionalizing the mechanism, and waiting. And the behavioral science tells us that this kind of normalization is extraordinarily durable precisely because it doesn't feel like imposition. It feels like reality. People don't rebel against reality. They might adjust their preferences about how reality should be configured, but the baseline premise that income taxation is a permanent, natural feature of economic life, that premise sits below the level of political debate, in the realm of unquestioned assumption. Now, I want to be very clear about what I'm not saying. I'm not saying taxation is wrong. I'm not saying governments shouldn't have revenue. I'm not making a libertarian argument or a conservative argument or any partisan argument. Questions about what tax rates should be, what they should fund, how the burden should be distributed, these are genuinely complex questions where thoughtful people disagree. What I am saying is that there's a layer beneath those debates that rarely gets examined. The psychological architecture that shapes how we experience taxation in the first place. The defaults that determine what feels like loss and what feels like normal. The mechanisms of salience and invisibility that determine how acutely we feel the financial impact of the system. The processes of normalization that determine which questions are politically askable and which are too obviously absurd to raise. Understanding that layer, understanding how it was constructed, what tools were used, how it was implemented across different societies, gives you something valuable. It gives you the ability to see a system for what it is rather than simply for what it feels like. And that distinction matters because the feeling of naturalness is itself a product of institutional design, not an indicator of truth. Here's why this matters well beyond the specific question of taxation. We live in an era of proliferating defaults. Digital platforms make choices about what your default privacy settings are. Financial products are structured with default investment allocations. Healthcare systems build default coverage assumptions. Workplace arrangements embed default expectations about availability and hours. In every one of these domains, the architecture of the default is doing enormous amounts of work that most people never notice, because the whole point of an effective default is that it doesn't get noticed. The history of income taxation gives you a masterclass in how defaults get built, how they persist, how they become normalized, and what it takes to even begin seeing them clearly. That education is transferable. Once you've watched that process unfold in one domain, you start seeing it everywhere. Not with paranoia, not with the assumption that every system is a conspiracy, but with a kind of clear-eyed awareness that the things that feel most natural, most obvious, most inevitable, most simply how the world works, are often the things that were most deliberately designed to feel that way, and that recognizing the design doesn't mean rejecting what was designed. It means you're finally seeing it clearly enough to actually think about it. The next time you look at your pay stub,
the gross and the net, that gap that your eye skips over so automatically you barely register it, maybe pause for just a second. Not with outrage, not with ideology, just with curiosity. What would it feel like if that number looked different? When did you learn to see this one as normal, and who benefited from you learning to see it that way? Those are worth asking, not because the answers are simple, but because the questions themselves are the beginning of actually thinking rather than simply feeling about the systems we live inside. I'll see you in the next one.